we've been in absolute deflation since June 2022. Now, the question is, if we've been in absolute deflation for that long, how has there not been a serious crisis? And there's been a regional banking crisis, but they kind of got control of that for now. There hasn't been like a crazy 2008 crisis where everybody thinks the entire financial world is going to end, in a matter of days or hours. That we haven't seen that yet. And the question is, why not? Well, I believe it's because of the reverse repos. We're seeing that all this money that was printed in 2020 and 2021 is now entering the bank system just now. So we have this like sort of delayed QE that couldn't get into the system back then and now is getting into the system once this tank runs dry and interest rates they don't even have to go up from here. They could just stay where they are. There's going to be a scramble for dollars.
The world faces significant economic uncertainty as global market consensus rapidly shifts. The U.S. Treasury yield spread has been inverted since July 2022, often signaling a recession within a year. According to Rafi Farber, since June 2022, the economy has been experiencing absolute deflation. Interestingly, despite this deflation, there hasn't been a severe crisis comparable to the 2008 financial meltdown, which nearly resulted in a total financial collapse. Rafi attributes this relative stability to the presence and impact of reverse repos. During the COVID-19 pandemic in 2020 and 2021, the Fed initiated massive monetary stimulus programs. They printed substantial money to support the economy and financial markets. However, this created a problem. Too much cash in the system could lead to hyperinflation or other undesirable consequences. To avoid this, the Fed needed to remove some excess cash from the system temporarily. This is where reverse repos come in. Beginning in April 2021, Federal Reserve reverse repos became a major source of the Federal Reserve's control of its net assets. Farber argues that this reverse repo process has allowed the money printed in 2020 and 2021 to enter the banking system over time slowly. It's like a controlled release valve for the excess liquidity created by the Fed's monetary policy. Rafi suggests that if and when the reverse repo facility becomes exhausted, it could trigger a scramble for dollars. Companies and banks may need cash to meet their financial obligations, causing a spike in dollar demand. This increased demand could lead to higher interest rates, a sharp drop in asset prices, and potentially a financial crisis. We will now bring you clips from Rafi Farber's interview with Liberty and Finance. But before we do, if you want more videos like this, hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
The basic story is that in 2020 and 2021, the Fed printed so much money that banks couldn't handle it all. So there was backup, and they needed a place to put all this cash so that they didn't just like dump it into anything that they could dump it into and then have the money supply really just go crazy vertical in a very short period of time, which might have triggered hyperinflation at that point. So they needed a facility to put it into that would earn the bank's interest. They'd be incentivized to put it there outside of the banking system. And that's all the extra money. I think it topped out at like 2.3 or 2.2 trillion in 2022, mid 2022, something like that. And now it is at 1.36 trillion, if I remember correctly. So basically about $900 billion have come out in about 15 months or so. Now, there's been a question, if you look at the money supply, and I look at this, now it's published every month on a weekly basis. It publishes the four weekly data points every month. It's now released. We've been in absolute deflation since June 2022. Now, the question is, if we've been in absolute deflation for that long, how has there not been a serious crisis? And there's been a regional banking crisis, but they kind of got control of that for now. Well, I believe it's because of the reverse repos. We're seeing that all this money that was printed in 2020 and 2021 is now entering the bank system just now. So we have this like sort of delayed QE. My thinking is that once this facility runs dry, and it runs dry basically by the government raising the Fed's raising debt, the Treasury issuing more debt in exchange for that reverse repo cash, which is then put into the banking system. So once that reserve tank of dollars runs dry, then you have all of these companies and banks paying these high interest rates on their debt service costs, and they have no reserve tank to draw from. So, look, the financial crisis could happen anytime. It could happen tomorrow, but I think it is almost certain, and nothing is certain. And I could be missing something. I've been wrong before, but I think it is almost certain from my monetary Austrian school perspective that once this tank runs dry and interest rates they don't even have to go up from here, they could just stay where they are. There's going to be a scramble for dollars, and then instead of being able to withdraw cash from the reserve repo facility, they'll have to sell assets to raise the dollars that they need to pay off their debt. And from there, you'll see a spiral of asset prices, and from there, everything should go. And then the Fed's going to have to print and reverse everything, and from there, I think the dollar explodes. Look, in the end, the Fed's going to have to decide: do they want to save the bond market, save the Treasury market, and allow the dollar to fail, or do they want to allow the Treasury market to fail and the federal government to go bankrupt and everyone who's invested in Treasuries to lose 100 cents on the dollar? But then the dollar would still exist, at a much lower nominally gold exchange ratio. It could even go back to 35. But even if it does, if you have a stock portfolio, it's going to go almost everything's going to go bankrupt in it, except for maybe the gold miners. And even though in that scenario, gold would go back to $35 an ounce, the purchasing power of it would go way up, relative to that. So the number doesn't even matter. So they're going to have to choose, they're going to choose the dollar or the Treasury market. It's one and not the other. You can't save both. So they will save the Treasury market because in the end, they're a bank and their friends are banks and the banks own the Treasuries, and they'll sacrifice the dollar. There's nothing else they can do.
Rafi Farber points out that Japan's heavy reliance on money printing as part of Keynesian economics has led to economic stagnation. However, this strategy has backfired, leading to a prolonged period of stagnation known as the lost decades. This economic struggle has caused Japan's debt-to-GDP ratio to soar past 250%. If Japan's experiment with money printing fails, it could have far-reaching consequences, raising doubts about the fundamentals of Keynesian economic principles. The alliance between the United States and Japan has continued since Japan's World War II defeat. He highlights that the Bank of Japan owns a significant portion of Japanese government bonds, around 47%, creating a vulnerability. The Bank of Japan made unexpected government bond purchases on October 4th to dampen government bond yields and bolster the yen. According to media reports, the central bank offered to purchase 675 billion yen in 5 to 10-year Japanese government bonds. When Japanese government bond yields rise, the yen's value decreases, causing the central bank to incur massive losses. To counter this and strengthen the yen, Japan could sell its holdings of U.S. treasuries, which would temporarily bolster the yen's value. However, this action would increase U.S. Treasury yields, impacting the broader U.S. economy. Let's get back to the interview.
I'd say the fulcrum of the Keynesian system, the Keynesians, the money printers who believed that monetary policy could massage an economy and make everybody rich or at least prosperous in some way, that inflation creates wealth. Basically, that's what it comes down to. That really relies on the poster child of Japan. And Japan, after World War II, after they were nuked twice, the horrible thing that happened to them, they became the poster child of Keynesian economics. And we see that now in their debt to GDP ratio, which itself is a Keynesian measure. It's like 260%, 270%, some ridiculous number. If money printing works, then Japan proves it. If money printing doesn't work, Japan's going to prove it hard. And it looks like they're on the verge of cracking. So this entire alliance between the United States and Japan has been going on since their defeat in World War II, and now I think they're going to be a big player in the unraveling of the entire Keynesian system, which relies both spiritually on their example and practically on their not imploding, which eventually is going to happen pretty soon, I think. And the mechanics of that are basically that Japan right now owns, I think it's 46 or 47%. The Bank of Japan, meaning the printer of the yen, of which the yen is the liability of that bank, owns 47% of all outstanding Japanese government bonds. So when you have a central bank that prints your currency, 47% of their assets are the bonds themselves. When those bonds go down, that central bank goes into massive losses, which even the Fed is experiencing, just not to the degree that the Bank of Japan is, because the Fed doesn't own 47%. I think they own like 20 or 30% or something like that. It's still, an atrocious number, but it's less. So when Japanese government bonds go down, meaning when yields go up, the unit of liability of that central bank also goes down in purchasing power, because what the definition of the yen is now everything that's on the other side of the balance sheet. So if rates go up, the yen goes down. And we can see this. I don't know if you want to show the viewers or just take my word for it, that if you look at a chart of the yen versus the dollar and then the 10-year Japanese government bond yield, as the yield goes up, the yen goes down in purchasing power relative to the dollar. So it's a pretty tight chart. The correlation is there. So what can they do to strengthen the yen? Well, they can sell treasuries, because Japan, again being the Keynesian poster child for the whole world, owns, I think, $1.1 trillion worth of treasuries, of long-term treasuries. So they are the biggest foreign holder of treasury debt. They could theoretically sell that debt, and then they would get dollars for that sale, and then they would sell the dollars versus the yen, and very temporarily, even ephemerally, strengthen the yen. I think we're even seeing that today. The yen was at 150 per dollar, and then something happened. We don't know exactly what yet, and it went like this, and then it went down to 148, which means the yen strengthened a little bit. It could be the Bank of Japan is doing something. But then again, like it shows that Japan and the U.S. are tied at the hip. If they sell treasuries, then they raise the yield of U.S. treasuries, right? Because if you're selling, it goes down in value and the yield goes up, and then that increases the differential between the rate you get with holding dollars and the rate you get holding yen, and that weakens the yen itself after a very short-term strengthening. So no matter what the Bank of Japan does, it's going to weaken the yen. There's no direction it can go. Yeah, there will be like short spikes up in the yen, but they'll very quickly be followed by plunges down, along with U.S. interest rates, which I see the spiral already starting. Maybe it's not, but it looks like it.
The inversion of U.S. Treasury yields and previous spikes in inflation have sparked concerns. However, the controlled release of liquidity via reverse repos has prevented potential crises. A sudden increase in demand for dollars could lead to higher interest rates, declines in asset prices, and potentially trigger a financial crisis. What are the main factors influencing global financial stability amid these economic uncertainties? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.